Good afternoon, all. Welcome to this third webinar in our series of 10 with Clive Lambert from FuturesTechs. We're going to carry on looking at support and resistance, and Clive's going to look at some patterns within that, and I believe we're going to do a bit of Fibonacci as well. Clive, are you there?
Hello, Chris. I am, yes.
Good. You well?
I am, yes, yeah, all right, yeah. Can't wait to crack on with this and get some more methodologies out there to our listeners.
All right, over to you then, Clive.
Okay, thanks very much, Chris. Okay, so I think if you were in attendance last week, then and if I can find my if I can hang on a minute, sorry, I've lost the ability to change slides. There we go, I've got it now. Right, I think we all remember this chart from last week where we were talking about the definition of an uptrend and the definition of a downtrend, and introduced the idea of support and resistance levels that were created during that process, if you like. So we're going to take things a little bit of a step further today and look at some other ways of trying to find support and resistance on charts. And obviously, in finding support and resistance on charts, you can also then create or come up with trading ideas and trading opportunities, and you can structure trade ideas around the support and resistance levels that your chart is suggesting to you. So let's have a look at other ways, as I say, of looking for potential support and resistance. And the first one I want to look at today are trend lines, okay, which are a very simple thing, but it's very often badly drawn, if you like, or people disobey the rules. And there are some rules which you need to stick to in order to be able to use these effectively. They are just straight lines which join a series of points on the chart, but yeah, it's important to draw them properly. So a resistance line is a downward sloping line from top left to bottom right, if you like, that actually joins a series of lower highs. So if we were in a downtrend, you would have those lower highs and lower lows, and if you can draw a straight line above those falling highs, then you have yourself a trend line. And it is amazing how often markets move in a sort of a reasonably uniform manner. You know, there's randomness within the uniformity sort of thing, but the actual sort of velocity of moves can be quite often reasonably consistent and can be defined by a line. So that's what we have there. We have joined this high here to this high here and this high here, and then we've got another couple of highs. It's very difficult to see on this chart because the shadows on the candles are very, very thin. So, but be assured, I have placed that line on top of all those candles, and immediately that talking about shadows brings me to a question that people ask me: is should you include the shadows? And I try to include the shadows as much as possible when I'm drawing trend lines, because price did trade at those prices, although we'll see later that it is something you can have a little bit of flexibility with when you're drawing trend lines. But yeah, the important thing is to have 3 hits for a trend line. If you were to just randomly join together any 2 highs on a chart, you could end up with a lot of lines and none of which that are of any real use to you. So try and stick to that 3-hit rule, and then you can narrow it down to the lines. It's not so arbitrary, and you're actually looking at the lines that are defining trends rather than just arbitrary lines that are drawn between sort of random data points on the chart, if you like. So that's an important thing to remember. Okay, so support line is the opposite. It is a rising trend line. It is it joins higher lows, and here we have a support line on our chart. And as we can see, and this is the DAX actually from, and I think last week we were looking at the DAX, and we talked about this trend line, and we were saying that was going to, that there was potential support there at that trend line, and it broke. Okay, and it broke and it gave us a reaction lower. So that was the important thing we saw there. We actually, so that gave us something of a, and that's why we've seen a weaker tone in the DAX over the last few days and so far this week. Okay, so support lines are drawn underneath price action, so they're upwardly sloping, and they are joining higher lows. A sustained or closing breach of trend line is a valid break and indicates a change of direction. One thing that this chart shows is where a support line breaks, which it broke here, and then does a job as resistance on the retest. Okay, so that's something that you can watch as well, and we'll see this. This is the case with any support and resistance type of work, really, and says to us that you should keep an eye on trend lines after they're broken, because they might have one more thing they can do for you. Any support and resistance, to be honest, and I think, as I say, I've got a nice example of this later on, I think, with one of the other methodologies we're looking at. We've got the change, what's known as change of polarity there, where a former support line has turned into resistance, right there. Now, once you've drawn a trend line here, once you've drawn an uptrend line there, you may sometimes eyeball it and think, well, hang on a minute, there. If I was to have a parallel line to that and put it on top of the highs, that would mean that the market is travelling in a channel, and that's what we had in the DAX as well over the course of the last few months. And so that was a trend channel that we had in the DAX, because you can see the highs, bang, 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 here, were also hitting the parallel line there. So that was a nice channel that worked for a while. One thing I would say about trading, if you're using channels, is to be careful not to use the hitting of an uptrend of the top of a channel line as an excuse to try and short the market. We can see actually it would have worked well in this particular instance right here, but it is a dangerous game, because actually the trend is higher. That's what the uptrend channel is telling you, and so what the trade you're trying to do is going against that, and it's a dangerous game, if you like. I think I may have touched on it last week, that from my point of view, and especially for traders who are fairly new to the game, it's much easier and much better to try and trade in line with the trend as opposed to trying to bet against the trend. And that's especially true if you have very established trends like we've got in the for example, the US stock market at the moment. I think if you'd have spent the last 5 years trying to pick the top of the US stock market with short trades, then, well, you probably wouldn't be around for 5 years to be able to do that, because it's completely gone against you. And the better trade would have been, and continues to be really, in US markets anyway, in particular, to buy the dips and to trade in line with the trend. Okay, DAX, maybe the trend has changed. That's what this chart is actually telling us, and this is this was the chart right up until yesterday. There's an example of a downtrend channel. So you draw the downtrend line, and it's important with channels to draw the trend line first, and then see if there is whether there is a return line that can be put in there. And obviously that one's not perfect because there's a small sort of glitch in the matrix right there. But there are, you can allow some interpretation at times. And again, so my key thing I would say is the bottom line on a rising channel is the most important, and the top line on the falling channel is the most important. And you can then, if you can translate it into a channel, just use the other line as a guide, if you like. Okay. I'm seeing we've got a question coming through about the markets, but can we will have some time at the end to look at some live charts, and then maybe we can think about that at that point, so I can get through the presentation. Cheers. Right, so that's trend channels. One other thing that you might be able to find on your trailing systems is the volume histogram, and if when a trend line breaks you see an uptick in volume, then that can be a useful indication that you're not alone in thinking that what's actually just gone on in front of you is trend changing. So if you see a break of a trend line on rising volume and or rising volatility, then that can be that can be a nice bit of extra confirmation, if you like. So what defines the strength of a trend line? Three things really: the angle, the number of hits, and the length of time it's acting. It has been acting as support or resistance. You know, and I think that you know, I think the angle is an important thing here because it's obviously a very steep trend channel. It's obviously defining a very strong market, a market that is you know, quite rampant, if you like. But as a channel, as a line, you know, that line is very unlikely to continue to be able to hold because it becomes unsustainable after a while to be able to continue that level of rise, if you like. So actually, the less steep trend lines are probably you know, are often deemed to be stronger, if you like. Clearly, obviously, the number of hits on a trend line is important, and then the length of time that the line's been acting in support and resistance is obviously another consideration. Okay, so that's you know, the trend lines, they're there to define the direction of the trend. And as I say, we often find that trends have a reasonably what's the word? A reasonably consistent path, if you like. They can be applied to any time frame of chart. I know people that use trend lines on anything from a 10-minute to you know, 5 and 10-minute charts, right up to dailies, weeklies, and monthlies. So they can provide you with support and resistance levels. And I often feel that trading using trend lines offers good risk reward and a good reference for disciplined trailing stop management. Okay. Now, what do I mean by that? Let's try and give you an example of that. Let's think. Market, shall we? Hang on a minute. Right. Okay. Here we go. This is the silver chart. Okay. And silver, I drew this line from here, joining this low here, and then these lows under here, and so we're now, as of right now, silver is sitting on that trend line there at 1680. Okay, now if you were to buy silver because it's sitting on that trend line, you can put your stop below the trend line, and you can say that all the time that the market is traveling higher and holding that trend line, then you're staying in the market. You can move your stop higher with the trend line. Okay, so if the trend line in 2 weeks' time is at 1720, then your stop would be below 1720. And if in the meantime a steeper line comes along and you're wanting to tighten up your risk maybe, then you can just move the stop to below the trend line. And actually then that completely takes out of the equation any emotion, if you like, with respect to, oh, where do I put my stop? Okay, you can just say, I will put my stop below the line. The line's rising, therefore I should be winning. As long as, you know, and all the time you're above the line, then I'm winning, and my stop can be is protected by that trend line, and so it moves higher. This isn't the best example because it's not a very steep line, but you know, I think the theory is there, if you like, and the idea that using a rising trend line for stop placement is a good idea. Okay. So what else did I say there? Yeah, trend lines don't have to be drawn from absolute highs or lows. Okay, it is, you know, as long as you use that three-line principle, that three-hit principle, you can draw them from any points on the chart, really. don't be shy about drawing trend lines on your charts, because it's only by doing that that you'll nurture your skills at what I feel is an important method of analysis. It's one of the sort of cornerstones, if you like, of the technical analysis toolbox that I employ myself. Okay, so as I say, we can look at some more sort of live examples of this as we go towards the end of the presentation. Okay, now we're going to look at some chart patterns, and I've got some of these on the slides, but I've actually, one of the patterns that I'm looking at today, I want to look at just on the actual on my charts on that we get through the DF Markets platform. But we'll start off with double tops and double bottoms. We were talking about our higher highs and higher lows. What happens if you get two highs at the same price? Well, then you look lower to the low between those two highs. So here we go, we've got two highs at the same price. We've hit some resistance. Clearly this is an important area of resistance. What's the low between the two highs? Draw a line on that, and if we break that, you get a double top sell signal. That's the classic textbook technical analysis signal. Now people get a little bit, they get their knickers in a twist a little bit with this one, because a lot of people, when the market is here, start talking about a double top, and here start saying, oh, we've got a double top. And no, according to the textbooks and according to the back testing that's been done when these patterns were devised, you need to break the low between the two highs in order to get the sell signal. And again, coming back to a little bit to last week, what we were doing last week, where we were just drawing horizontal lines on the charts. That's exactly what we're doing in this instance. So we've got this M-shaped top, and we've got a sell signal when we break the low between the two highs. Quite simply, the double bottom is everything but in reverse. Basically, you've got two price reversals at the same low, and then you look to what the high was between those two lows, and if we break above there, then we get a buy signal. So there's a low and a rally, and then we go back to a very similar low, and then when we rally, we're looking at this level here, and we're saying if we break above there, we get the buy signal, and that's what we get there. And that again can offer you a nice trade with good risk reward. And this is a double top on a 30-minute chart in Euro US dollar from a few weeks back. Okay, we got up to 118.55 here, sold off to 118.25, rallied against 118.55, and then again, actually that's probably a triple top, okay, because we've hit that 18.55 level 3 times, and then we broke lower, and here is where we got the sell signal. Now, I looked at this, I remember this one because all of this occurred basically while I was asleep, and I'm not a big one. I don't sleep for days on end or anything. I have to get my charts done and provide my analysis to my clients. But no, this actually happened at about 8 o'clock. This high was in the afternoon of that day, and then by the evening we traded down to here. That was over. That was back late on in the late US trade, and this was in Asian trade. This one here, and so we got the sell signal about 7 or 8 o'clock in the morning here in where I am in the UK, and so you could argue, well, that's too late then. You missed it. Well, two things you can say about that is, one, you can say that, well, it has told you that a top is in place, so you can look for shorting opportunities from that point. And the prime shorting opportunity is a retest of this level here. And I actually said to my clients on that day, in a note that I sent out sometime around when the market was here, if we get back to 18.25, that is a selling opportunity. And that's what happened on this candle here. Back we went, came off. Same sort of thing here, back to 18.20, and then the market sold off. So actually, even though we'd missed the actual signal, if you like, at the actual time that we were given the actual signal, it still presented us with a potential trade setup and some opportunity and a nice trade there. Okay, so that's a double top, or triple top actually, on a 30-minute chart. Interestingly, the euro yen on a daily is currently possibly forming a double top, but we haven't had the signal, and this is what I'm saying. This is an important thing. Okay, there's a high there at 134.40, I think it was, something like that. And then we traded down to 131.60, traded down to 131.60, traded back to 134.50. Okay, so very similar highs there. And so we look to what's the low between the highs. It's 131.60. If we break, and so what I've been saying to my clients for the last week or so is, if we break 131.60, then we will get a sell signal. And this one's been playing silly beggars with us. And this is an example. I'm trying to show you an example of something that, you know, that where these things can become difficult and where they don't, you know, the markets don't always play ball. Because last week, on a couple of occasions, we actually dipped through 131.60 on a couple of days, and we bounced. Okay, and there we go. Those lower shadows show the market, and it happened here as well, market dipping through this key support level, but then the buyers stepped back in. Now what this is saying to me is we're not ready for the sell signal yet. Okay, now one other thing that I would say about this is with the double top, there's a measuring technique. Okay, you can say that high is 134.50, this low is 131.60. Okay, so we have 290 pips from there to there, and you can project those 290 pips from the breakout point, if and when we get the breakout, which we haven't, and you can say we've got a target down here because we're saying that this measurement can give you a measured move target to you know, to where we might go to if we get the signal. But yeah, so I thought it'd be interesting to show that particular chart because we have been waiting for the signal, but it hasn't come. There's been a couple of false dawns, and there's been a couple of times where that has actually has rallied back, you know, has dropped through the breakout level, but not done so convincingly, and then bounced back by the end of the day. So again, it's important to wait for a close in this situation, and that would apply to any time frame chart. You have to wait for it to close above or below a particular level to say yes, that pattern is completed and we have got that signal. This is a nice one we saw recently, and again the shadows don't show up very well on here, but we've got Treasury notes, 10-year notes, the US bond market basically, putting in a low here, rallying, putting in a very similar low here, rallying. This is a 4-hourly chart, and then when we got this buy signal here, then off we go. We came back to retest it here, so that was nice. The way you see the way that the former resistance level turned into support here, and again, if we were to measure from here to here and project, then this was the area where, you know, that suggests we could go to, and very interesting to see that that's around where the market topped out and fell over again. And I do believe we're back down here now. I put this side together yesterday. We have continued back down, and we're probably due to retest this area here at 124, 124.12 for the 10-year notes in the US once more. Okay, so so that's double tops and double bottoms, and again, so we're just drawing horizontal lines on the charts. And when I'm playing with chart patterns in particular, my own personal preference is to use orange trend lines so that I can differentiate them from other trend lines and other lines that I might be using for other work. So if I'm looking at double tops, double bottoms, or the head and shoulders pattern, which we're going to look at next, I always change my trend line color to orange. And I think that this sounds like a really silly little point, actually. And I mean, you know, we were talking about gaps last week. I use blue lines for gaps, and I think it's useful to have a similar kind of key, if you like, to your lines, because then you don't need to, you know, you don't have to intensely stare at a chart and try and work out what's that for. You can say quite clearly, oh, that's orange, yeah, that's that double top, or that's that double bottom. And so to our charts. And what I want to show you now is the euro against the US dollar, because what we had, let me try and can I? Right, because what I want to show you is something called the head and shoulders pattern. Okay, and the head and shoulders pattern it's a little bit like going back to our first slide that we showed today. Let's go back. Let's hang on. Sorry, just give me a second. I've lost my slideshow. That's annoying. Where's it gone? Sorry, peeps. Just give me a sec, and I'll get this sorted. Swap presentation. Yeah. Okay. Remember this. Okay. And we've got the higher highs and higher lows, and then lower highs and lower lows. If you see this, high, low, new high, trades off, trades up again, but this third high here doesn't reach that one, and then we sell off, you've got yourself something called a head and shoulders pattern. And here in the euro US dollar, back in August and September, we made a high here, 120.68, sold off to there, rallied to here, and that was on the 7th of September. Sold off again to here on the 13th of September, rallied again on the 19th of September, and we've got a high, a new high, a lower high. So we've got this potential head and shoulders thing forming here. What you do then is find the lows between the three highs and draw a line. And again, I made that line orange, because if we were to break that line, you get a sell signal. And we got the sell signal right here for this particular pattern. And again, we can measure from the top of the head here to wherever the line was on that day, and project that from where the neck. This orange line is called the neckline of the head and shoulders. And if you project that from where it breaks, you get a downside target. And in this instance, okay, we've got a sell signal at 118.50. We at the time, you can stop yourself out if we go back above the line, but we had a sell signal at 118.50 and we had a target of 115.90, I think, on this at the time. So that's a decent return for the trade if we were to hit the target against, and you can work a fairly tight stop on that, and so the reward to risk is very good on the trade. And this is interesting because we're going to, and actually what we saw was a sell-off down to 116. What was that low on that day? Let's have a look. Down to 116.70 here, and then we rallied and back, and we hit that neckline and then fell over again. So we actually never got stopped out, and we actually got a second opportunity to get short right around here. Okay, and it's been slightly messy, but it's worked out rather well, this one. But then took a step back from it. Let's take this one off, and let's look at this now. What have we got here? There's a shoulder. That whole, if you class that whole thing as one big ugly head, a bit like Chris's. And then this is the right shoulder. Okay, so that means we have a much larger head and shoulders on this chart. Let's find the low between those highs, draw an orange line on there, and when we break the orange line, we get a sell signal. And we got that sell signal here at 116.70 on the 25th of October. And we subsequently sold off to 115.50 by the 6th of November. Now, the reason why I'm showing you this is because right now, today, we've broken back above 116.70 and those highs there at 116.85, and we are currently negating this signal. We are currently, actually, this rally here is saying that sell signal that it gave us is now been negated. And you know, we need to have we need to rethink our recent bearish skew. We need to maybe get out some of those short euro US dollar trades, and that's exactly what we've been seeing today. We've been seeing, I think, people getting out of those particular trades. So that is a head and shoulders top. Now this is something that's confusing me at the moment slightly, though, and bothering me, if you like, and I just need to find the chart. Where is the chart I want to show you? This is the dollar index. Okay, so this is the US dollar against a basket of everything, basically, if you like, and the US dollar, you know, the dollar index is actually, again, similar looking chart to the euro US dollar if you were to completely turn it on its head. Yeah? Okay, just turn that upside down. Turn the euro US dollar upside down, and you've got this. You've got a, you know, so this is called a head and shoulders bottom. There's your left shoulder. There is your head, and here is your right shoulder. And again, if we've got that set up at a bottom, then we find the highs between our three lows. Stick an orange line on there. And there was the buy signal right there. Okay, now again, we haven't done much with this buy signal yet. Actually, that buy signal suggests that we should head up to somewhere up here, 97.12 for this dollar index, because that's the measured move, if you like. We can throw something on here, a retracement thing on there to show you if we get that at 50%. So yeah, 97. Something like this is a rough estimate. Somewhere around 97.23 is the target, right up here. Okay, we'll look at that a bit later. Let's just remove that for now. And again, with this one, we've come back to retest the neckline, so we've got an opportunity, and that's right now as we speak. In fact, it is retesting that line on the dollar index chart. So that's actually, unfortunately for us, is a slightly different story to what the euro US dollar chart is telling us. So one of them's right, one of them's wrong, and we'll know at the end of the day which is which. And as far as maybe putting fresh positions on right now, it would be maybe prudent to wait, especially if we're putting on longer term positions, to wait until we get some clarity on that. Because yes, this is still saying that the US dollar is bullish and is going to 97.20, whereas the let's find it again. Whereas the euro US dollar chart is saying that the bearishness we've seen in this of late has been negated now. Okay, so you know, and this is the thing. Charting and trading is not straightforward. It is not easy. It is not something you can do in 10 or 15 minutes a day. If you are tempted to sign up for a service that says, you know, we'll guarantee you profits for, and you only have to do 10-15 minutes work a day, then I would really, you know, suggest, I would really steer you away from any of those sort of ideas and any of that sort of talk. Okay, this is, you know, it is difficult, and I've been doing this a long time, and I still get plenty of moments where I'm scratching my head. Okay, so that's the head and shoulders, and at the moment, as I say, we're potentially getting that. Well, it looks very much like that particular head and shoulders is being negated. Interestingly, I suppose, we've got some form of support there at 117.30 from that low, and that low, and that's where we've come back to. And actually, if we look at the anatomy of that large red candle there, 117.38 is an important level on that chart, and that's exactly where we're trading right now. So for me, right, let's say in an ideal world, if we want these head and shoulders patterns to continue to be front and center, we would see a sell-off in euro US dollar over the rest of the day, and we'd close back below 116.70. So let's see if that happens. And then everything's still on for this bullish dollar trade. Unfortunately, we live in a world where Mr. Trump likes to put his aura in regularly, and that can actually can mess up my charts sometimes. But there you go. Right. Okay. So that's a little bit of work on and a little bit of a look at chart patterns. Hopefully, looking at live patterns and my analysis and my thought processes on sort of live markets has given you a bit of a taster of how to put these things into practice. Let's get back to our to the slides now, and we're on the home stretch here with a look at this rather good-looking chap here, who is Leonardo Pisano Fibonacci. He was born in Pisa around 1170 AD, son of Guglielmo Bonacci. Often referred to as the greatest mathematician of Middle Age Europe, and is widely accredited with introducing the Hindu-Arabic decimal number system to Europe. He also came up with what's known as the golden sequence of numbers. The golden sequence being this sequence right here: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 130. Where's the next one? 134, etc., etc. Where do we get those numbers from? All we're actually doing is adding one number to the next. 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, 5 plus 8 is 13. Okay, so at the moment it just sounds a little bit like an 11 plus question, as far as I'm concerned. What does it actually all mean? It's actually when you take each number in the sequence and divide it by the number before it that we see quite an amazing pattern emerging, because it comes out at a very steady, once you get into the bigger numbers, 1.618. And 1.618 is known as phi, P-H-I with a capital P. If we then go on and divide 1 by phi, 1.618, we get the answer of 0.618, a number known as phi, and is written with a small p. And so everything's all rather uniform and symmetrical, isn't it? And this has fascinated mathematicians for many, many years. I've got at the bottom there, yeah, it even made its way into one of the last decade's best-selling novels. Does anybody remember the novel I'm talking about? It's the book that I think I read somewhere that it's the book that's most widely in charity shops in the UK, and it is the Da Vinci Code. There we go. Got a couple of people on the chat there, straight in there. Well done, guys. The Da Vinci Code, you got it. Now, this golden mean, golden ratio isn't just of interest to mathematicians. It's also got some amazing occurrences in nature. If you look at rabbit breeding numbers, leaves on a tree, florets on a broccoli stem, one of the common images is the shell, the spiral shell, which has some rather marvelous sort of Fibonacci-like what's the word I'm looking for? I don't know. I'm losing it anyway. And proportions of the human body. It's amazing how often the Fibonacci sequence, the Fibonacci numbers, crop up in nature. Architects like to use Fibonacci ratios and numbers in their work because it makes for very pretty looking buildings and windows and things like that. I think there's a Fibonacci restaurant in London actually, and I haven't been there yet, so I should try and get along there sometime. But we've also noticed these numbers having quite an effect, if you like, on financial markets, an affinity to Fibonacci numbers. And one of the ways that I want to show you today is when markets are retracing, when you are seeing a market that has been on a trend and then is pulling back some of that trend, and quite often we see that those markets pull back by 38.2% or 61.8%. 38.2% is 100 minus 61.8. Now, most charting systems add those lines. You can track those lines on the you can put those lines on a move on a chart, and it will show you. You know, you can put in where it started, where it ended, and then it will show you where the 38.2% retracement is and where the 61.8% retracement is as well. And most charting systems also throw the 50% in there as well. And here is a chart for gold, and this is a monthly chart for gold, and shows us the move that was seen from 2011 when gold topped out at 1950, somewhere around there, all the way down to 1050 by the time we got to the beginning of 2016. And so there's the start of the move. There's the end of that move, if you like. And here we have that first line there, that green line, is the 38.2% retracement. So when we're getting close to that, people like me are saying, people like me are saying I'm very, very interested in this particular level here at 1380. And when gold fell over just shy of that, literally about $2 shy of that, it wasn't a big surprise, and we came all the way back down to here, down to 1125 before we saw a rally again. Now, the way I use the Fibonacci numbers, and so that says to me gold 1380 is a massive level in gold. 1378 was that high. So 1378 to 1380 is a really big area. And the way I use it is I say, if we see the sellers returning there, I will not be surprised. However, if we do get above there, then I will target the 61.8% retracement, which is 1585. And if we can clear that level, then we can look for a move back to the highs. So there's a bigger picture analysis of gold using Fibonacci. Okay, 1380 is resistance. It's been proved to be resistance because it's the 38.2% retracement of that sell-off. If we were to get above there, then our targets are 1585, and if we can get above 1585, the next target would be the highs back at above north of 1900 again. So that's the monthly chart, and that was the reason why we were, if you like, always wary of 1380 as a level. If we go down a time frame, down a couple of time frames actually, to the daily chart, we can look at this year. Okay, this year we saw a rally. Well, this isn't all of this year, this is the second half of this year, so from June onwards. We got down to 1204.5 in the middle of July, and then started to rally quite nicely, higher highs, higher lows. Got up to here, 1356 by the beginning of September. That's called a shooting star. We're going to talk about that next week. And then we gapped to lower, and that gap's still there. Another gap there as well. And we sold off. And when we sold off through 12.9, you know, when we were selling off, I said 12.98 is my first target, and that was the 38.2% retracement of that move there. We didn't register at 12.98. We just dropped through, and then we chopped back above, and we chopped down again, down to the 50% retracement. So 12.98 did nothing for us at that time there. But once we broke 12.98, I said 12.62 is the next Fibonacci target, and that's this line here, the 61.8. And look what we've done. We've bounced off of it there, rallied, come back again, bounced off of it there, and we've bounced from just above it there. Okay, now gold's had some really nasty down moves over the last few days. Friday, it had like a $10 drop in a blink of an eye, basically. And it's done exactly the same thing overnight this morning. We've dropped from 1277 down to 1270 in a matter of minutes. And usually when you see moves like that, you'd be getting very, very bearish and very, very worried about the market. But actually, what I'm looking at in gold, what I think, despite those moves, we're holding this 1262 level, and we're holding it firm. And so I'm thinking, as a bigger picture trade, buying these dips in gold is a sensible thing, and we should be looking to try and get long on these dips, use them as opportunities to get long, as long as we hold 1262, which is this big Fibonacci support level that is proving itself, because we've been there twice already and we've bounced. Then I think we've got scope to go higher in gold. And so that's how I'm using Fibonacci in with the combined with, and if we hit Fibonacci levels and see reactions, then they just get stronger, basically. So that is that's the end of the slides that I've got for you, and so I think if anybody's got any questions, or if anybody wants to have a quick look at some live markets, then I'm more than happy to do that right now. Hang on, we got Chris. What's Chris got here? Okay. Sorry. Okay. So I've been asked, is it still a buy dips market in the DAX? Let's have a look. I can show you. It'll be easier if I do it on my own chart system here in the DAX. Right. The answer is no, actually. Although Mr. Fibonacci says yes. Okay. So we've got mixed messages there. We broke the channel. We broke the channel. Okay, so I think that's a bearish development. Okay, the Fibonacci level is 12895. Okay, and also look, it was the low there, it was the low there, and it was the low there. So the last chance to buy a dip in the DAX is that level, that area there, 12,900. If we break 12,900, and again we're using the Fibonacci here, then that is our next target, 12,500, and that is the 61.8% retracement. And actually with the DAX, 61.8% levels are, it has a particular affinity to them. So that's the the analysis for the DAX at the moment is, I'm not buying dips because we've broken the channel, but if we were to buy a dip, 12,900 is the level. You can run a tight stop, but if we break there, then we're going to 12,500 next, basically. 15-minute chart on the DAX, is that, looking at the 15-minute chart of the DAX, is that an inverse head and shoulders pattern? Let's have a look, shall we? 15-minute chart, okay. Let's get rid of the parabolic signals. Right, okay, so on a 15-minute chart in the DAX, is that an inverse head and shoulders? Potentially, we have something like that. I'm not completely. Let's just change. I'm going to change this to a 30 because it might show us a bit more clarity. And get rid of these, shall we? Right, so if we are doing any sort of head and shoulders thing here, that would probably be your left shoulder. That's your head, and now we are potentially forming the right shoulder. But it is too early to say just yet. What you could do, this is the moment where you say, we don't know yet, but let's put a neckline on it. Okay, which is joining that high to that high. Okay, we'll make that orange. Oh, I'll just do that anyway. So we don't know at the moment. Actually, no, at the moment it's just a downtrend, yeah? Lower highs and lower lows. However, if we don't get back to here and then we do break above here, the orange line, then yes, we have a head and shoulder, an inverse head and shoulders pattern that's formed there. So that's, that's the thing. You don't buy the dip now. You don't buy it now, expecting it to go through here and to go through here. Wait for it to break into that, break above that neckline, see if we get a solid reaction, and then go long, because if it does happen, then we've got what, 12,957. Well, it's 200 point. It would signal a 200 point move. So if it was to do it, say this afternoon, it would be somewhere around 13,117, and it would say that we can go to 13,317. So your target is somewhere up here, sort of thing. Okay. Hi, Mr. Beginning previous. Okay, someone's asking about getting previous copies of the session. Chris, you can sort that, can't you? Looking back is nice, putting up channels in Fibonacci, but how to determine when a channel starts or when to put up the Fibonacci fault lines? Andrew, the Fibonacci, where to start Fibonacci lines is a difficult subject, actually, because and as a general rule of thumb, I would say you look for the entire move. But I do have a few of my own little rules in there that actually I don't find that everybody subscribes to. But I do have a few rules in there, and maybe it's something we can look at on a later webinar. I have got some slides on it, but I haven't included them today, and we're now a little bit time specific. Channels is just very much, I just as I said at the end of the trend lines, as my summary on trend lines, just draw the lines, just draw lines on there, remember the 3-hit rule, and then just develop the craft yourself a little bit, if you like, and then you'll find the stuff that works and the stuff that doesn't work. But you don't have to go for absolute highs and lows for trend lines, is something I would say. Okay. What are the best MACD settings? MACD is something we're going to cover in another, oh my goodness, why does this do this every week while I'm doing this? MACD is something I'm going to do another week, but what I can tell you is that my settings are 12, 26 and 9, which are the standard defaults that everybody uses. But as I say, MACD, we're going to look at with RSI and stochastics in week 7. So, come back then and we'll talk in some more depth about MACD. Right, guys, thank you very much for listening. Hopefully there's a few bits in there that you've found of use and that you might want to try and apply, and and again, go away with these things, play around with them, and come back, and hopefully come back next week. And if you've got any questions on the stuff that was covered this week, or then based on what you've been doing, then please do ask those questions. Thank you very much.
Clive, thank you for that. Very, very informative. Thank you everyone for attending. Like Clive said, we'll be here next week for the 4th in the series of 10. In the meantime, if you've got any questions or queries regarding the service and products that we offer, please do contact us via the website, and we've got a live help function up here. You can also access that through your trading platform or on the general office number or email address. We're more than happy to get back to you to answer any questions that you might have. Thank you very much, and we'll see you next week.